right, our next topic is going to be Economic and Automotive Outlook, presented by Erin Keating, Executive Analyst and Senior Director at Cox Automotive, and the John Murphy, Managing Director at Haig Partners.
All right, thanks for joining us for this session. We're very happy to have Erin Keating. The folks at Cox are, as Steve just mentioned, really are thought leaders in the industry, at least in my opinion. They provide great data that to us, in my old job and in my current job, and are really helpful in understanding what's going on in the industry. And I find myself many times speaking to Erin and her compadres at Cox, and starting a conversation you think is going to last for about 5 minutes, and you're on the phone for about an hour and a half, and I've gone through a lot of stuff in the industry, which happens. It seems like in a blink of an eye, but it takes a long time to get through. And there we go. I dropped my stuff. Off to a great start. So I think one of the big things that we struggle with in the industry right now is a lack of understanding of how strong things are from a macro perspective. And when we look at last year, we finished with a 16.2 million unit SAAR. I think if we were kind of look 3 or 4 years ago, everybody would say, okay, that's a great year. And oh, by the way, pricing was pretty strong, close to $50,000. As I look at this and have been looking at the industry for a very long time and tried to figure out how we forecast this, I've kind of thought about the forecasting this as a capital goods replacement cycle with a consumer overlay. So periods where you run into a shortage of vehicles, I think like we are right now, late model vehicles, is a period where you're going to see significant pent-up demand. And I think we estimated 10 million units because we've had such a shortage of sales over the last 5 years or 6 years since the COVID supply shock. But the consumer overlay really is not very supportive right now to unleash a market that's far, far higher than that. And I do think over time, there's potential for it to go higher. I think potentially up 20 to 30% over the next 4 or 5 years if we see better pricing in the market, more affordable vehicles introduced, or from many automakers, particularly the Japanese and Koreans, probably more likely than a D3 that have walked away from them. So, as we think about this, or I think about this, I'm pretty optimistic. Now, sometimes other folks have less optimistic views of where the market is. I think, Erin, you and the team might be a little bit more somber, and a little bit maybe more realistic than the dreamer than I am about the industry. What's your take on what's going on with new vehicle demand right now and where it's ultimately going to go?
Well, first of all, thanks for having me. Good to see you all. I would first of all say that, yes, our team, I guess, would be a little somber, and that's our job to be rational so that we're not overexciting on expectations. But I'm with you on being more optimistic, perhaps, than most people think. The affordability issue is real. There was a significant price increase that happened in those years during the pandemic. Really, interest rates are what doubled over the time span of when we look at 2013. We recently looked at data where it takes now only about half a week more pay to afford a new vehicle than it did in 2013. That's 13 years, and yet we're still sort of at the same average number of weeks it takes to purchase a vehicle. But what doubled over that time was the interest rate. So the burden of the financing has really significantly increased for consumers, and they're starting to purchase over longer periods of time, right? So the financial burden there is actually pretty significant. But we certainly have we can't ignore the fact that cars have gotten more expensive. And in fact, to your point, a lot of the manufacturers have moved away from the less expensive vehicles, and price competition has really been there. And because it's so competitive in the market, it's really not allowed the manufacturers to think about hitting the consumers with higher pricing because they have to maintain market share in their particular segments. Even though you see the domestic three, as you say, walking away from some of those segments, arguably, questionably, why they're doing that. But yeah, I think, we do have pent up demand, and that is a real thing. Scrappage rates are bound to have to rebound. We have a solid amount of vehicles in operation right now that are 13, 14, 15 years old, even 16 years old, that have got to get replaced. They're just simply becoming too expensive to maintain.
And one of the other big debates I think out there is on the supply side of the equation, which obviously has an impact on pricing. When we look at total U.S. inventory on dealer lots right now, you're right about 2.7 million units. Now, that's far higher than it was in the supply chain crunch, where we're down to 1.1 million units, but still far lower than the traditional rate around 3.2 million units. So, how do you think about this? I mean, from my standpoint, the market generally, from a finished goods inventory, is still relatively tight on dealer lots, but there's certainly pockets of excesses, certainly pockets of real shortages. What's your take on the current supply environment at dealers?
I mean, there's a couple things, and you all know it best, and we'll look at it in a couple of slides. I mean, gross hasn't necessarily been this wildly profitable area for new car sales anyway. So the idea that volume matters is a little bit questionable, especially when the manufacturers are continuing to keep invoice in parity with what MSRP is, or average transaction price, and in fact getting that to be even slimmer these days. And for those of you that are familiar with poker, they were buying the pot for a while, right? Like you're at 17 million because financing is cheap, and you're incentivizing the crap out of the vehicles, right? We were at 10%, 11% incentives back when we were buying 17 million sales, and now we're down to 6-7% incentives. And so whether it's necessary to go back up to 4 million, I don't think any dealer wants aging inventory sitting on the lots. And without it being more affordable, you can't move those vehicles as easy. And there's no real incentive for the automakers, especially with all of the tariffs and new things that are coming into play, and the Chinese nipping at their feet, their ankles. There's no real incentive for them to lower the number of cars that they're building, or expand the number of cars they're building, because we simply then get into a inventory glut.
So also on the used vehicle side, because we've been selling so low, it's built up all this pent up demand. There's a real shortage of late model used vehicles. I mean, exactly. I think the first time I saw this was back in 2008, 2009. I was a stock analyst at the time at Bank of America, and we were incredibly negative on the stocks and the industry at the time. And there's one of these moments where when you're that negative and trying to figure out when the industry might possibly turn, the sign that I saw was the total number of vehicles on the road in the United States shrank for the first time in history. The total number, not 0 to 5, not any buckets. That was the first and only time that ever happened. The second time it happened was in 21 and 22. Sure. Right. So we've had these real sort of wedge factors or extremes in sort of the structure of the market that really are supporting pricing from not just from the new vehicle side, but also from the used vehicle side. The other thing that I think is really important to understand that a lot of people are incredibly skeptical about, and you kind of just touched on this, Erin, to some extent, is that automakers do have a fair amount of discipline. And when you look at this capacity utilization in North America running at about 70%, that's kind of a crazy number versus history, right? If you were saying 10, 20 years ago, the industry was running at 70% capacity utilization in North American plants, every auto manufacturer would be losing their shirts. They'd be bleeding cash, they'd be burning through their balance sheets, and they'd be in a lot of financial straits. Now, because of the focus that you just mentioned, Erin, of the right vehicles at the right price, they've found that at these much lower capacity utilization levels, they can actually make a whole lot more money. And if you were to look at this, any manufacturer could really hit the gas and produce a whole lot more. And you can certainly argue there's some pockets, particularly potentially at CDJR stores or Nissan stores or other places. But this is a really kind of amazing stat to me, that there is that kind of discipline. I mean, as you think about that, what's your take?
The only thing that could potentially change this, obviously, is tariffs. That we have seen about 3% more vehicles being produced in the U.S. Frankly, that's just capacity building. I don't think that anyone in here believes that we're going to see some sort of massive injection of cash into the production from foreign automakers specifically into the U.S. That's mostly because everything's been announced, and people seem to forget that foreign automakers have been investing in the U.S. for decades, and they will continue to do so at the rate. I don't expect it personally to be exponentially higher than they have been, especially when you see that utilization is not at its full capacity. So I do think that we could potentially see capacity come back or get smaller at some of these factories, for the mere fact that you've got to switch production to the U.S. to avoid some of those tariffs, but also potentially for export. But it doesn't necessarily change the inventory levels that we would perhaps see here. It will just change the mix of what you see that's built here in the U.S., potentially what's exported from the U.S. But I agree with you. I mean, they're recognizing that even if it's more ideal for your balance sheet to be running at full capacity or near full capacity, given what demand is and the cost of vehicles, and especially the cost of producing vehicles in the U.S., this makes sense.
One other thing I would mention is thinking back to the period of 2001 to 2009, where pricing totally fell apart in the industry. You had GM that had more than a third of the market, with a totally screwed up balance sheet, with a wildly underfunded pension plan, with a wildly underfunded retiree health care plan, with fixed labor costs because of the union contract. And you actually don't have any automakers that are in that dire straits right now. You can argue some of them are not in the greatest shape, but they are not stuck in a position where they really have to overproduce that marginal vehicle to drive volume, to theoretically drive marginal profit. All that didn't work either because we said big bankruptcies.
They're looking at diversifying what they do in the first place by necessity, honestly, which doesn't necessarily help those of you in the room. But we do know that various things are being done to diversify what it is they're producing or what they're producing where. So I think that that's for the automakers, from your previous perspective, it makes sense to pay attention to how they're diversifying their revenue and their production and what they're planning to do with their business. But it doesn't necessarily mean that we're going to see a significant increase in actual new vehicles hitting the lots.
So the punchline of this supply versus demand is that pricing at large is going to stay fairly strong, and that's an industry sort of dynamic that I think is going to hold probably for longer than people realize. You guys have done some great work on retail price versus wholesale price. I don't know if you want to talk about this a little to kind of lay out what's going on here. I certainly have some views too.
Yeah, I mean, again, talking a little bit earlier about margins here on new vehicles. I mean, as we saw, yes, we grew a little bit. We that gap widened during the pandemic. That dark blue line is the average transaction price that we track. And then the red, magenta, pink line is dealer invoice. And so we're seeing that it has tracked, essentially. So while real dollars may have actually grown over time, it's not holding up. So you guys are feeling the pinch from invoice to MSR to average transaction price. And we certainly have been tracking this over the last year, trying to see where is the manufacturer showing up with these increases in tariffs. And I'm sure all of you have felt this at the bottom line. The invoices are rising faster than MSRPs at the moment, depending on which manufacturer you're looking at, as well as destination and handling fees, which of course don't necessarily benefit you and only go to increase costs for customers. The wholesale, we obviously saw this spike in values happen through the dearth of new vehicles being provided. But those are also, used vehicle prices are also coming back in line with what we're seeing in wholesale. And so really everything just seems to be stabilizing. Nothing's dipping tremendously, but we're stabilizing. So.
Yeah, and I think at the moment, you guys all in this room are living and breathing this on a daily basis. It certainly seems like new vehicle grosses on a GPU basis are going to hold up better than where they were pre-pandemic in 2019. How far they adjust back down from where they are right now, there might be a little bit of a fade, but just given the dynamics in the market, they're probably settling into a new normal. But certainly the competition in the used vehicle market has driven used grosses to levels that are similar in absolute terms to where they were in 2019, which means inflation adjusted, there's been some real compression as that market continues to get more competitive and there's a shortage of vehicles. Theoretically, if the supply goes up, ironically, you actually might get a more fluid market, less efficient market, and those grosses actually might see a little bit of relief going forward.
I mean, remember, though, used vehicles, especially that's starting to replenish, watch out used Teslas. I mean, it's our inventory in used vehicles are shifting towards EVs. Now, still, I always like to remind everyone we're talking about a pinch of the actual vehicles in operation and such. But used vehicles are the ones, our used EVs are the ones that are coming off of lease right now. Some of the most affordable and or most prevalent models that you're going to see specifically are going to be Teslas, Chevy Bolts, these things that were popular 3 and 5 years ago, or the only options that you had 3 and 5 years ago. But we do anticipate that by 2027, I think it is 2028, that we're going to continue to see this increase in all of those electric vehicles that have been leased over the last few years coming back to dealer lots. So it is really important for you as dealers to pay attention to that, whether you really believe in EVs, whether you've been able to push them in your particular markets or not. that is going to be where a good amount of supply is coming from. Those off-lease vehicles in the 0, 1, 2, 3-year-old vehicles, which are right now, in general, that vintage is holding up.
So one of the other things that we hear constantly from the market is that there aren't a lot of great affordable vehicles out there.
Yeah.
And the reality, you guys have done some digging into inventory levels by price point. So maybe you can explain this chart and what you're really getting at here.
Yeah. So the dark blue line, the dark blue column there is showing what percentage of sales in 2025 were in each of these price buckets compared to what we're currently seeing in inventory right now. So the real story here, obviously, the $30,000 to $40,000 price bucket. This is probably the most in balance, but the most in demand segment here. So we seem to be holding the right amount of inventory with the right amount of anticipated sales in that particular price bucket. We're actually undersupplied in the under 30,000, which we know we've complained about that, most of the manufacturers are pulling back on producing vehicles that are under 30,000. The 40 to 50,000, of course, is where sort of middle market lives and breathes. And this is where the consumer is just not going for the stretch payment, and we're falling behind and keeping pace with what the inventory is doing versus what the sales are doing. Then, we all know this K-shaped economy, and this really is what this is showing us. That $50,000 to $60,000 range, people are just fine. We seem to be supplying it at the right volumes and selling, and it's matching. So similar. So 30 to 40 is sort of your bottom of your K-shape or bottom to middle, and then your 50 to 60 is, middle to top, middle, maybe lower upper, if you will. 60 to 80 holding up really well as well. We know that the K-shaped economy is definitely benefiting higher income households. We are undersupplied there just a bit, and that will be a continued growth. I think I just saw very first sales reports that came out today. They're reporting, and Honda, Toyota actually saw some pretty decent increases in January. Hyundai, Genesis, all seeing increases, but it's those most expensive vehicles, the bigger vehicles. Where you might want to be a little bit careful, especially if you're a luxury store, is that we seem to be oversupplied in the over 80,000. And that could be an area to watch, because I think there was a lot of belief that the higher income individuals are just going to keep purchasing, and clearly they're getting price sensitive as well too.
Okay. Before we get on to some competitive threats in the market from the Chinese as well as USMCA, I wanted to put my tinfoil hat on here for a second as an economist and think about money supply and what it means for inflation, because this is something that never gets discussed. And if you really think about inflation, as Milton Friedman said, it's everywhere and always a monetary phenomenon. And there's a lot of factors that even everybody keeps talking about that influence money supply. But this is a graph of M2, so hard dollars as well as dollars that are in deposits as well as digital dollars. If this keeps going up, right, forget about everything we just talked about, the auto industry, you're going to continue to see all prices going up, including vehicles, right? It's a very, very simple concept. If you have a certain amount of stuff that we all have that might go up slightly year over year, but your money supply is going up faster, you're literally translating the value of this stuff and measuring it by the dollars. So if the number of dollars keep going up, you're going to have inflation. So there's a lot of smart people running around talking a lot of different factors, but this is really important. And I think when we look at Kevin Warsh coming in as the new Fed chair, it gets pretty confusing, because he wants to cut interest rates but at the same time shrink the Fed's balance sheet. So that will kind of be competing forces to what will happen with this money supply over time. But I think as you look at deficit spending, potentially lower interest rates, the money supply is going to keep going up. And when you're talking about a big ticket item like a vehicle, people complain about it a lot because it's a big number, right? And it's it's a big scary number. But the reality is, and we'll talk about this in a couple other slides later in the day, inflation for autos is only slightly outpacing total inflation. It's just a very high line number. Now, when you talk about insurance and other costs of owning a vehicle, those have inflated more. But the actual price of a vehicle is up only marginally more than general inflation. It's a very interesting point. Now, another thing we wanted to touch on real quick.
John, just going back to the price point on vehicles. The other thing that I think people don't give enough credit to is that, you go every day to the store and you see your bananas and your avocados and your coffee and your beef or whatever. You only go back to the well on a new vehicle or a used vehicle every so many years. So whatever your brain was trained on 5, 10 years ago is significantly different. I mean, I know I bought a car in 2020 at 0% interest and what that car payment was. And if I went back and tried to buy the same as that car 5 years later, yeah, I'm sticker shocked. It's $300 to $400 more a month than it was then, or double the price. And so I think that's we forget that they really don't go back to the well that often. And so the sticker shock really does feel much worse than it actually is.
It's real. It does. It is a little bit scary. We're gonna hold the fire on this to the next. You and I are gonna talk about USMCA in just a few minutes. This is just a reference point for everybody in the room to understand as you're looking at your different brands, where your vehicles that you're selling are coming from. And we're going to talk about the importance about this with USMCA in just about three or four slides. But we just wanted to put this up because it's very difficult right now with everything that's going on with the current administration and how they're shifting policy around, to really call where tariffs and everything are going to go. We wanted to make sure you guys had this sort of as a reference point. We're going to talk about USMCA in a second. But I also wanted to talk about what's going on in China. And this isn't here on the shores of the U.S. so far yet, unless you talk about Volvo and Polestar. So they are Geely, right? They actually are here, 1% of the market. When you look at what's going on the global stage over the last 25 years, there's been, massive growth in the global auto industry, but the entirety of that growth has come from China. They were doing a couple million units in 2000, about 36 million in 2025. So they've taken over the planet outside of North America, the U.S., and they will continue to do so. The idea that any of the companies that you represent are going to be able to compete in the mass market anymore outside of the U.S. is over. And it's a reason why when I counsel folks at GM and Ford that they really need to strip back their business or retrench to the North American truck market as well as focusing on their global brands. This is important, not necessarily for you directly in the U.S. right now. It will be at some point. But the reality is the folks that you're dealing with at the manufacturers are dealing with incredible stress. And for that reason, they're going to continue to lean into the U.S. market and maybe acting in ways that seem a little peculiar as they go to the one market where they're still making a lot of money and they don't have this competition. Well, the other thing that's kind of wild is in the last 5 years, if you look at the red line here, this is net imports and exports out of China. The Chinese have gone from basically zero net exports to about 6 million units last year. So the competitive stage has gotten incredibly tough. And if you think about this in the context of global supply versus demand, the global market is around 90, 95 million units. If you pull out the U.S. and China, you get closer to 50 million units. So if you think about a 6 million unit increase in supply relative to that 50 million number, you're seeing more than a 10% increase in supply versus demand on the global stage outside the U.S. So this is an extreme move in the global auto industry, not on the shores here in the U.S. yet, but the folks that you're dealing with are dealing with this directly. So, understand some of the actions that they're taking and what impact it may have on your business, meaning they're going to get more aggressive here in the U.S. to survive in the mid to long term. Now get to the road ahead, right? I think we would agree that this year probably be a pretty good year from a demand perspective and a pricing perspective, and things will probably hold together fairly well, but it'll probably be pretty volatile. And Erin and I kind of put together this chart to show some of the key events to think about as we work through the course of this year. Folks on the East Coast certainly know what's going on with these chilling winter storms that have shut down business. So that's kind of something that's been pretty disruptive to start the year. But something that might be really good is the tax refund season. And Erin, you guys have done a lot of work on this. What's your take?
Yeah, we have. And a lot of, obviously, when they were trying to pass the OBBBA that gave all of these tax incentives back to individuals and businesses, they had pre-estimated that individual consumers were going to see a lot more in their paychecks. We see it's like average $750, or in their refunds, average $750. But what's really interesting about it is that it's actually having a pretty big impact on the higher income households, arguably a better impact for the higher income households. Granted, that means we probably won't see that hit until closer to April, because the people that are, filing now are the ones that are expecting and need that refund to come back in. So we certainly expect and anticipate that, like any good spring bounce, it's going to be pretty decent this year, because individuals are not only getting more money back in their paychecks because of the tax tables, but also they will be getting more of a refund this year and could be using that. The conundrum there is how many of those consumers, especially on the lower end of the K-shaped economy, are going to be leveraging that to pay down debts. So whether it's that their Christmas expenses just came through and they're seeing that and they need to pay that down, or that they're going to be servicing and maintaining their car because they've been holding off on repairs there. So certainly an opportunity not only for fixed ops, but also an opportunity to think about what price point for that service and repair is going to push them into looking at a new vehicle. So definitely, and we'll talk about fixed ops in a minute, definitely an opportunity. But I would really encourage you to get familiar with the geography of where the tax refunds will hit. Certainly, SALT, the state and local tax exemptions, are really going to help, again, those upper income quintile households. And that could, or more surprisingly to people, impact how they're actually spending money, the perception of a windfall there with taxes and tax breaks. Because we do typically think of tax refund season as, okay, this might drive some down payments on used vehicles, or again, it might help, increase service drive business. But this particular refund season might get a little interesting for us, given the impact it's going to have on the higher income households.
Right, and another big event is the USMCA renegotiation that I think it technically gets done July 16th, but is going to have a lot of noise around it. So trade is not gone in the sort of the furor of volatility.
Noise. It's just like the IEPA with the Supreme Court right now. What's really important for everyone to realize is the USMCA, it absolutely needs to be negotiated. We do want the president and the administration working with Canada and Mexico to solidify those deals. But we do think that there's going to be a lot of bilateral, trilateral agreements on the side, similar to what's been happening with every other nation. But more importantly, the Sector 232 tariffs, which impact the automotive industry, are independent of IEPA and they're independent of USMCA. So even if they kick the can down the road with USMCA, even if they negotiate it, if nothing is done about the Sector 232 tariffs, it doesn't ultimately change a huge amount of the picture here for what happens with manufacturers, especially for that North American supply chain, unless within those negotiations there's significant changes on content, or what they're requiring, what kind of exemptions they're offering through the Sector 232 tariff. So it's, pay attention to the headlines a bit, but just remember our industry specifically is screwed. We're tied to those Sector 232 tariffs, and nothing has really changed in that aspect. Nor do we hear the administration saying they're going to do. In fact, they're going to go more towards Sector 232 tariffs if IEPA gets knocked down. So could be interesting.
So I think the key message here is that kind of like 2025 as a forecaster, somebody thinking about the full year, you might get the full year correct, but every month incorrect. Right. So just mind these events as you go through the course of this year, because there could be some real volatility. But where we do think there's extreme opportunity in the dealer business, and you're going to hear this repeated through the course of the day, and Steve Greenfield alluded to this chart that I put together. This is a slide that we've developed called Path to Higher Profit. And really what it's meant to show is what you all as dealers capture and what you don't capture in the life cycle of a vehicle. The reality is the auto industry in the United States is about 4% of GDP at the front end of the value chain, where you guys capture, and there's about another 4% in the aftermarket, which you capture part of. The front end that you capture in dealerships is about $1.2 trillion in revenue. Profit that goes along with that on an operating basis is probably in the 55, might be closer to $60 billion, because you've been doing pretty well recently through all the verticals that you operate in new, used, fix, and F&I. So that's great, but it could be a lot better, because as you look at the life cycle of a vehicle and of all vehicles on the road in the United States, there's another $1.2 trillion that's associated with the vehicles on the road that you guys are not capturing. And that $1.2 trillion, or that second $1.2 trillion, is about $135 billion of operating profit. So about 2.5 times what you're capturing at dealerships. So it's a little bit of tough love in saying that you need to focus more on used and fixed ops. And if you do it by just a couple of years, you can actually make a whole lot more money. And I think over time, what we're hearing from automakers is they make a lot of money off of OEM parts, and they would like you to do this. And I think you're probably over time hear more and more coming from the manufacturers to push you to do this as well. But the reality is you're the gatekeeper in getting access to this, and it is your opportunity more than it is theirs. So I think this is something that, as I've joined the team, that I'm going to really focus on helping you guys realize. But Erin's got some really good perspective on this as well.
Yeah, and I mean, and let me start out just actually in advance of this, and having worked for a manufacturer before and years ago when we were discussing this, we shouldn't be ignorant to the fact that you all are dealing with a significant challenge of multiple powertrains now. The amount of money that you've been asked to invest in the EV business, now that hybrids are growing, for sure, fixed ops and service and maintaining vehicles gets to be a more expensive proposition because of the tooling, the training, et cetera, et cetera. So I don't want to ignore that, because I know that that's a significant challenge and or cost that is added to the business of being able to add bays, add technicians, et cetera, on top of everything else. But we do an annual service study, and a couple of different things that sort of stood out to us. One, we have seen 7% increase in VIO from 2018 to now. So we do know that there is an aging fleet. People are keeping the cars longer. So there is more service needed. There is more service opportunity. When we did this study, we did come up with the threshold of pain, if you will, for consumers, around $3,100. If the repair is going to be $3,100 or north of that, just keep in mind that is your equity mining, goal there. Keep an eye on what your ROs are estimated to be. Make sure your service staff is well equipped to handle those conversations when you're looking at what the total cost is going to be for that maintenance or for that repair, et cetera. But we've also seen that dealers are actually losing share. So while VIO has grown, service opportunities have grown, dealers have actually lost 4 points in market share. And most of that has been going to general repair shops, quick lubes, mobile service companies. Granted, there was a lot of hope there that with increased technology, EVs, et cetera, that, hey, this automatically is just going to send a lot more business back to dealers. Because of increased warranties, especially around EVs, but because the tooling is so sophisticated and the right to repair thing, legislations hasn't been worked out in every state. And so independent repair shops can't get access to all the computers and necessary technical equipment they need to be able to get after. That could change now that most manufacturers are going to go ahead and turn up ICE business again. So that competition should be seen as real and still in the game, regardless of how technologically advanced the vehicles get. But they are getting a bigger share. So that's a real opportunity to go capture market share from these independent shops. And so while the reality is that dollar figures, revenue went up 33%, it grew because the total market actually expanded. And so there's a lot of real opportunities here. And in that service study, we did a lot of work to find out why or what is the gap. And a lot of customers were saying, look, convenience. It wasn't actually price. Convenience was the number one. And we actually saw it declining, return to dealership declining pretty significantly for under 2-year-old vehicles. And there is no reason a dealer should be losing business on a 2-year-old vehicle or younger, 3-year-old vehicle, 4-year-old. Again, given the complexity of the cars, there's just no reason that business should be going to anywhere else other than back to the dealers, given warranty, et cetera. A lot of it is a gap between service and sales not being linked up. When someone's coming in to buy a new vehicle, there should absolutely be that immediate introduction to the service department. That is where the relationships are built. I'm not telling you all anything new. You know that your repeat customers come from those that are actually engaging with you and being a part of your business. But so convenience, how do you message around, are you doing pickup and delivery? Are you offering mobile service yourself? So that's number one. 2 is the price gap. And what's really interesting to us is that actually independent repair shops tend to be more expensive than dealers, but that's not the perception from consumers. The consumer's perception is that you're going to rip them off. And it's just not true. So be mindful of where you guys can be messaging out to your consumers on what those price comparisons could be, even getting price comparison tools built into your digital ecosystem to say, hey, you could go around the corner, you could come here, look at the difference in pricing and be able to really see what the competition is on the ground. That's really becoming important to the customers. And again, it's a shame because the perception is wrong. More often than not. And so being able to promote what the difference is between your cost and the cost of general repair. So there's a lot of like pretty easy turn it on. Let's see how we can capture more share. Again, don't forget tax refund season this year. It's already begun. The first people who have filed this week have already started to receive their refunds. Go strong, go long in those messaging as we do through this next period of time. And then again, as we were looking at the calendar, having spent quite a bit of time back in marketing, I can say we got quite a few interesting live events, live sporting events coming up this year, which we know plenty of manufacturers are going to be engaged in massive marketing campaigns, especially through the summer when we've got World Cup and we've got Winter Olympics coming up. Winter Olympics is prime time for service in because of the tax refund season. So push on your automakers at your tier 2, tier 3 levels to get the right materials and assets to be able to push the proper messaging in your markets while they're also happening to spend a lot more on that marketing spend during those key live events, especially. So area of opportunity here for sure.
Yeah, so I think the punchline from the presentation is that the macro is probably not as bad as most people fear. It could be pretty volatile through the course of the year, but there's a huge opportunity, I think, as you all know, in fixed ops. And we have a few minutes for questions here. Erin and I are reachable. Here's our contact information. Erin has very kindly offered her contact information for everybody in the room, and the slides can be downloaded from this QRQ. So we'd be happy to take questions now.
Got a hand raised there.
Shoot.
How are you guys thinking about the net effects of tariffs, given the passive volatility we're seeing in various asset markets? For example, Japanese yen has appreciated significantly. South Korean won has appreciated significantly. Kind of offsets tariff. So what do you guys see?
So the question was, how do we view the tariffs relative to the volatility in foreign currency moves, which actually I think that the punchline of my simple dumb guy's answer is, they often offset some of this. So it's actually the net effect is actually not that large. And I think what's interesting, and I'd love to hear your view on this, Erin, is you're not seeing the tariffs come through at a lot of manufacturers that directly. And what I've heard from my friends in the automakers, as well as the suppliers, is there's a peanut butter approach being taken, where Trump is kind of right. Some of this is being spread around the world and not just in the U.S., and it's being funneled through in other ways than directly increasing invoice price or suppliers increasing their prices either. So there's a lot of mitigating factors, and currency, oddly, is kind of one of these natural forces, kind of like that money supply, where things just kind of level out, and there's kind of a water in the tub, and it can only reach one level. It can get volatile from time to time. But yeah, that's a good point, Erin. I don't know.
We did see what the hit was to the bottom line of all the manufacturers. They all had to talk through all last year, and at the end of the year, their earnings reports, they have been hit billions of dollars by tariffs. But we have not seen that increase in customer pricing. We do anticipate that we'll probably see a little bit more of it this year. Peanut butter approach for sure. We also might just see some laser focus on what some profitable models might be able to take. You have seen that we're starting to move some, Buick is going to start now making vehicles here as opposed to China. So, some strategic decisions, again, going back to leveraging that capacity that's available to try to make costs less expensive here. And we have seen destination and handling fees go up to kind of offset that. But the competitive market, again, most manufacturers right now know that in 2026, we are anticipating we're going down in new vehicle sales from 16.3 last year to 15.8 this year. It's not about the pie growing bigger this year as far as new vehicle sales. It is market share capture. And that is going to set us up for one more year where we probably aren't going to see those massive rises in pricing because the market just simply won't bear it. And they're going to have to find more creative ways to offset it. Now, granted, OBBBA also gave them a lot of tailwinds. EVs going away as a mandate is a big tailwind. So it's not all bad for them. And there's been some backfill to what's going to help them be able to power through the cost structure of the tariffs. But I don't honestly see tariffs lessening. And, South Korea now, we've got some challenges there for some of our major manufacturers. But yeah, that's what I would say.
I think we could maybe sneak one more in if there is not, but we're out of time. Anything pressing, I'll be around all day. I think Erin is going to be around all day, so you can get either of us. So thank you for joining us for this session. Thank you very much.